The title is Why Neutral Strategies May Dominate.
A strategy dominates when it achieves equal or higher returns while bearing equal or less risk. So what are we looking at here? We got the expected returns as a percentage and then the standard deviation of risk. You're saying more risk, more expected return?
Exactly. Less risk, less returns. Next.
Okay.
All right, going on to the next one here. So examining straddles. So it's reasonable to assume that the offsetting delta would reduce the directional risk and the straddle would be more profitable than either leg on its own in terms of risk taken and return. So you're looking at a straddle versus each position. So what you're saying is you have more risk potential just on one side of the market, on either side of the market, whether it be puts or calls. You have more risk on just a single position because you don't have that delta hedge from the other one.
So just this will be testing to those individual leg, right? Put or call. And then we put all those risks together, which will be hedging both sides, right? And we use those results. In the case of risk, we're going to use standard deviations.
All right, so getting on to the next slide here. So how is this how is this assumption played out historically? Does the risk reward advantage of a neutral strategy make it noticeably superior to a directional premium selling? So you're going to take neutral positions compared to one or the other directional premium selling position.
Exactly.
Naked calls, naked puts.
Exactly.
All right, so let's get to the study here. So the study, 2005 to present, every trading day, placed trades close to 45 days. So you compared selling at the money puts, you're managing them at the 21 days, at the money calls managed at 21 days, straddles managed at 21 days, and then the strangles managed at 21 days. I'm a little typo there, right?
Yeah.
21 days. And then so you're going to look at the average returns and the standard deviation of returns, or the standard deviations of risk. Of risk. Okay, so we're going to see how wide the risk is, as well as the returns on all those strategies. Beautiful.
Right. You got a lot of data here. This is over the last 20 years, right? 05 till now, just about 20 years, 19 years. So a lot of information. Go ahead.
All right. So the straddle achieved both higher returns and lower standard deviations of risk, even though the call side lost most of the time. If you look at a chart of SPY, it has gone up since that time. So you're naturally going to be losing on the call side. Tell me what we're looking at here. So we got annualized P&L as a percentage of the underlying.
First of all, when you take a look to this table, numbers speaks by themselves, right?
Okay.
When you see at the money call, at the money puts, in the straddle, this is the first table we compare the stats on both sides, neutral strategy. When you look to annualized P&L as a percentage of underlying, you see at the money puts have 32%. At the money call, it's a rules trade, right? Negative 40%. And the straddle outperformed by 40%, which means we have better returns when you compare neutral strategy and both when you compare one leg by its individual stats, right? When you go to the risk, which is standard deviations, here I didn't put percentage. I use actual numbers, actual money, right?
Okay.
So it shows at the money call, it's 130, right? At the money puts, 841. The straddle, which is neutral, it shows 602. And remember, when you trade, the only logic, which is simple for everyone who trade, we know like if you take huge risk, the return will be also huge, right?
Yeah.
And if the minimum risk you take also returns, you can expect huge returns, right? But take a look to this neutral strategy. Straddle have 602 risk in terms of standard deviation, right? And at the money put, you have 800. At the money calls, have 630. So this gives us the indication, like, in your life, we don't need to be mediocre, right? Tom hates this strategy. We don't have to be mediocre, right? We need to take sides. But when you are trading, I prefer to stay neutral when you won't take huge risk.
Yes, this shows me that we've obviously had some positive drift up over this period of time. And then, I'm in both cases of being bullish or bearish. Like if you're on one side of the trade, you should expect to have bigger potential returns, but you're also going to have bigger risk because you don't have any. There's no hedge in place on entry. And so it's easier said than done to look at 2005 to now and say, oh, well, I should have just sold puts the whole time. You know, that's a hindsight look back. Even if you are selling at the money puts, you're going to see the losing trades, the standard deviation of risk, to be much greater than what you have with the straddle. You don't have the upside profit potential as the naked puts do, but you're going to have wider losses. Your overall standard deviation of returns can be much wider because you have those tail losses.
Yeah. Even if you look at today return in terms of return on your investments, you will see the call it's negative 1.6, and the puts it's 1, and the straddle it's 2%. That's the annualized return on investment we get. If you see the standard deviation of your return on investment, which is the risk, so the puts will be higher, right? Yeah. Because there's so much noise right there. But the straddle, which is a neutral strategy, will be slightly lower according to the puts.
All right, jumping to the next slide here then. So even the Strangle achieved both higher returns and lower standard deviations of risk, even though the call side was a losing trade. And this is, I mean, anytime you look at a long time frame, you're always going to have losing short delta positions when you see the market has what, effectively 3x since 2005, 2x minimum. I mean, we're right there. So you're obviously going to have losses on any neutral or any short type position. The thing to key in on is that the losses on those select times to the downside are much greater because you don't have any sort of hedge on. You don't have any sort of short delta on your position. You're 1-to-1 to the downside. And you see it here with your standard deviation of risk being, much higher on the out of the money puts.
Exactly. And when you compare this slide with the previous one, you will see this trader has potential of losing more than Strangle, right?
Yeah.
If you see in terms of risk, the Straddle has more than 3x of losing, more than the Strangle has. Like for example, Straddle have 600 of the risk, but on the Strangle we have like 200, right? Which is my recommendation. I don't need to take recommendation, right? But the Strangle kindly outperform in terms of risk management when you're looking to long-term position.
Because you have more you can do with it. When you're just selling a put or selling a call, you can only roll it out in time or roll it up and out if you're on the call side. If you have a Strangle or a Straddle, you can roll. Both those options are bringing in premium and are bringing in value that you can capture over a period of time. Whereas with one-sided trades, if you're wrong on direction, that part of the trade is tough.
Exactly. And I don't think there's someone who wants to do the calls the wrong time because call sucks, right?
Yeah.
It's almost to say call sucks. So.
Yeah, I mean, until they work, the one once or twice. All right, let's move on to the takeaways here. A couple more. So while neutral strategies appear to outperform directional ones, we may still look to take directional positions to stay engaged and build core positions. There's nothing wrong with having a directional assumption.
Exactly.
However you build it, the things that we control on entry are volatility, time, or how heavy our directional assumption is. Those are the things that you can ultimately control with your positions. However, a purely mechanical approach looking to optimize returns given certain levels of risk may be exclusively to stay neutral if you're trying to take less risk on both sides.
Yeah, we don't mind if you take a direction on any side, but remember to say use mechanical approach for you to control your trades.
And be small.
Yeah, be small.
All right, last one, takeaways. So neutral strategies don't require any additional buying power, so it's logical to sometimes avoid picking a direction. Selling the call doesn't, against, if you're just selling puts, if you're selling a call against it, won't use additional capital, brings in more premium, gives you a little bit more potential value to capture through the life of the trade. In the example of the SPY, Straddle, and Strangle, it achieved both higher returns and lower risk than its individual components. Obviously, positive drift over 20 years helps, but in the short term on a trade by trade basis, better off with the neutral position.
Exactly.